Welcome everyone. It's great to have an in-person event back here at Edison. It feels like we are rolling back the years. I'm delighted to be partnering with CrowdX. We're both passionate about the smaller company space, and today we are bringing you the views of Gervais Williams, a veteran of investing in the small cap universe. I'm going to start with Gervais's book, which he put out in 2016. Two parts to this book. One was a set of views in terms of how the world's macro environment would develop. The other half of it was how to invest in that space. Gervais, if you could talk about the book that you put out in 2016, reflecting back on some of those views and how that's come to bear in the world today.
So it's been a very rich period for investment, and I think that's been driven by an unusual pattern, specifically, I think, with the Asian markets being open to the world. We've had a surge of deflating imports coming in, and so the cost of goods coming in has been deflating. Local inflation will still be there, actually, but the net inflation has been modest. And most particularly, we've had abundant supply. Supply has been right up here, and so although you might want to buy things, it's never been, demand's never really exceeded supply. You could buy more things from China there's more things coming from China than you could possibly buy. And the net effect was that even when we had downturns, and clearly we did have 2008 and 2020 and other downturns, if demand was down here and supply was up here, all you needed to do was inject extra demand. And that's what we used to do. You saw valuations of bonds were driven up, all that cash flowed into the world economy, earnings recovered, and share prices went up afterwards. So really, it's just been a kind of iteration of asset prices going through the roof, people making out like bandits, marvelous. Not very interesting for small caps because you can make money everywhere. Small caps were not distinctive. And the purpose of writing the book really was to think about what happens next. And this is back in 2016, and even at 2016, some of the seeds of the setback were already there. We were already beginning to see more uncertainty about imports from China. Clearly, Trump was elected just at that time, and so he was starting to move and saying, well, we can buy more from China, but what about local customers and such like? So from that point of view, some of that's come through. What we've seen more recently is much more unsettled aspects. It wasn't just the pandemic, but obviously what happened with the pandemic was the reliance on long-distance suppliers suddenly became very problematic, and security of supply became even more problematic after the Ukrainian conflict, so with energy prices moving through the roof. So what we've seen recently is both, with 2020 in the pandemic, we injected extra demand, but also simultaneously we saw supply come down, and then more recently with the Ukrainian conflict, we've seen supply come down further. So we've got a mismatch now. That's where inflation comes from, and inflation changes everything, right? So the last 30 years is over. Something different is going to happen now, and from that point of view, the purpose of writing the book was to say what happens next. And just to summarize, the conclusions were, first of all, China goes ex-growth. Interesting enough, that sounds kind of crazy, but if you go back to Japan, 1989, beautiful, second largest economy in that case as well, went up to the end of 1989, someone switched off the lights, demographics, too much debt. You haven't made a penny in Japan now for the last 30 years. Right? Second point is that, so I think world growth is going to be up there. Second point was valuations got absolutely crazy, over the last few years. So you've got, bond yields of 0 or negative in Europe or whatever, and bond yields valuations are going to move back up to normal. Equity valuations are going to move up to normal. That's a lower valuation and high yield, and so effectively we're going to see a bit of an unwind of what's happened in the last 10 years. And then the third element is, of course, that profit margins have been sensational. People don't realise, with all these cash being spent, but most particularly with all the debt buying extra product over the last 30 years, you've seen demand through the roof, profit margins have really risen. Generally, most companies' profit margins have doubled since 1985. They're record levels, and when we become more price sensitive because we can't afford everything, and when we start to repay debt, then you'll see those profit margins come down. So the bottom line is, in just simplistic terms, my assumption is that most asset markets don't go up for another 20 years, just like Japan didn't from 1989. So we've got a collective problem. the financial services sector have got a collective problem, because basically the chances are if you just buy a whole lot of index funds, ETFs or anything else, you won't make a single penny going forward. So that was the sort of summary of the book, really.
Yeah, I mean, and it was interesting that you know, we have reflected on, you know, the growth and the rise of passives over the last few years, and you're right that it was much easier for a bigger company fueled by debt, etc., to just pick up companies, to pay out the dividends, to attract the investment and keep that cycle going. We're in a different environment right now. One of the things you touched on with your book is that, yes, it's a market with stock pickers, but that in particular the UK is an attractive place to be. Now, a month is a long time in politics, as they say. Had this event been a month ago, perhaps we'd have a slightly different conversation. But interesting, you know, that the reaction to the mini budget, the impact on currency, your views, in particularly around investing in UK small caps, which is effectively, you know, your heartland.
So when I see my clients, and I go out and see my clients quite a lot of the time, I say, you know, the chances are, you know, with a more vibrant universe of small quota companies, listed quota companies, specifically, you know, they can expand faster, they can take advantage of immature sectors, they're young businesses, they're more agile, all the rest of it. The chances are we'll make more money than your mainstream funds. Mm-hmm. And I've turned up for the last 30 years or more, 35 years, and my clients, and I say, chances are I'll make more money than the mainstream market, and touching wood, we have, right? But of course, my clients say to me, well, that's very interesting that you're making more than the FTSE All-Share or something, but have you seen how bad the FTSE All-Share has been for the last 10 or 20 years, right? I can make more than the FTSE All-Share by buying, you know, a NASDAQ or an ETF or whatever it is somewhere else. So the bottom line is that actually, so what, right? My own view now is that, you know, all that capital gain, a lot of those strategies which have done so well over the last 30 years have been associated with capital appreciation rather than income, that actually there'll be a rebalancing. You'll still have some positions which are capital gain orientated, but there'll be a massive rebalance, an agenda change where people buy income. Why buy income? Well, if you buy a quoted company which generates good and growing income, you get compounding of income. So if you look at the FTSE, say 100, it hasn't gone up since 2000, right? It's pretty dull from that point of view. But actually, if you bought an index sort of fund, you know, in 2000, you've made heaps of money. Well, that's because the income, and then use the income to buy more income, and you get the compounding of income, and you've made heaps of money. So everyone, we kind of think we're just useless in the UK at all sorts of things, and we sort of are in certain areas. But the bottom line is, actually, the UK market is actually very distinctive from the rest of the world. And I think nearly everyone is going to rebalance into cash compounding, and I think they'll have to balance into the UK for that reason. But much more excitingly, this is the really exciting bit from my point of view, I don't just turn up and say to my clients now, you know, I'm going to carry on outperforming the UK mainstream market, which we think we are. But most particularly, if the UK market is now one of the best performing stock markets in the world, yes, I did say that, if it's one of the best performing stock markets in the world, and it was between 1965 and 1985 when inflation was around last time, a useless economy, it didn't grow much, we had 3-day week, we had the IMF rescuing us, we had dreadful politics. Bottom line was, actually, companies which generate surplus cash don't go bust very quickly. And if companies are going to go bust, it's going to get really difficult. And companies which are generating surplus cash don't just survive, but they can buy assets from the receiver. So an over-indebted company goes into receivership, is sold in a cash sort of neutral basis, needs a bit of working capital, can be acquired by, say, a big PLC, and add 3% to earnings and 3% to dividend growth. Well, that's kind of interesting. But come back to small caps, they don't just, you know, continue to survive. They don't just generate surplus cash, but they start off as a little business and they acquire another business, say a similar size, for a knockdown price from the receiver, and they deliver more than 3% earnings growth, maybe 15 or 25, whatever. And some of the little tiny companies do the same. They raise capital and do the same and generate transformational returns. So going back to the 70s and the 60s, it was a terrible time. The UK economy didn't grow very well. You might have assumed domestic companies didn't do very well. No, they did sensationally. They did sensationally, right? So coming back to all of this, right, I'm now saying to my clients, I'm not hoping just to outperform the UK market, because the UK market's going to outperform the world markets. The chances are, if I'm right, and if we do outperform, two big ifs, then we'll outperform most of your international funds as well as UK funds. Now that is a completely different change of agenda, and I have a high degree of confidence about this. Doesn't mean I'm right, but I have a very high degree of confidence, and so the whole agenda with clients is completely changed.
Okay, so there's two parts of that, and I think we should delve a little bit more into the outperformance of the UK market. But the other bit, which is I think interesting, is that you are promoting effectively the listed environment, which is very different to where we've been over the last decade, which is it's been great for a company to remain private, to continue raising money from private equity funds, debt, etc., and to continue fueling its growth through that. And you're thinking that there's a step change there that is about to happen, and actually the currency of being a public listed company, that permanent capital that's behind you, etc., is going to become attractive.
Yes, I mean, it's not just the UK, but if you look at the public listed companies in the US or anywhere else, the number of listed companies has gradually reduced, right? Yeah. And you would have been better off being privately funded, because you put in debt at 7%, and then it became 5 and 3 and 2, and so you kept on repaying your debt and getting a lower cost, and valuation was rising, and of course asset valuation was rising, and all the rest of it. But going forward, of course, debt is going to be poison, right? Because as interest rates rise, you suddenly find that you're not just paying this much, you're paying this much, and on top of that, you're finding that there's margin pressure, and your customers are changing, and volumes are under pressure, and all the rest of it. So you're going to find, unfortunately, not just a lot of zombie companies, but lots of ordinary, regular companies, particularly private businesses, are likely to go bust. And on top of that, of course, even if you don't go bust, you're going to find that some of your customers go bust, and you get a whole lot of bad debts, and that might make you wobble as well. So I think the great advantage of being listed isn't just that you've got the listing and your share price moves up and down, but specifically you've got external shareholders. So if you do get into trouble, you can go and see your external shareholders, say, I know it's unfortunate, we misjudged this, or it's not turned out quite right, but the opportunity is there. Would you like to write a check? But more important than that, much better, if you've got a stable business, you can say, I can buy that asset from the receiver. It's a knockdown price. We've got a cash payback of 3 years or 2 years or whatever it is. Would you like to write a check for a transformational return? And of course, we would be delighted to write a check for and you can't do that in the private business. So quoted companies for the first time in 30 years won't do just the ability to generate return and attractive returns, but most particularly actually be the asset capital structure of choice. Okay.
And when you're looking at the market today, I mean, we're seeing some extraordinary valuations and some very interesting companies. And I was looking at one of our clients, which is trading on a P of 3, and it's in a really protective niche of the market. So you'd imagine that it would continue. But it feels like there's a buyer strike out there, and that it's going to take some time to sort of get these valuations realised. The sense I get from the sort of the UK fund management community is that because capital is flowing out, they're being cautious in terms of deploying capital, because either they're worrying about redemptions, or they may need to back sort of other companies. So you haven't quite seen that point of those valuations starting to. However, it sounds like you've got to that tipping point, that bullishness has started to return. So I just want to get a perspective from within your own sort of fund. Is this now the time to actually start to play on those valuations? Or are you going to wait?
I'm not going to make recommendations about my own funds for obvious reasons, right? Yeah. But coming back to the pattern you're talking about, I mean, what's been happening in the last 30 years specifically is people have been making out like bandits. If you're in the UK, you've needed to kind of go up the risk curve, so you've needed to move into sort of some of the higher growth stocks, some of the mini unicorns, that kind of thing. A lot of the kind of more sort of volatile AIM-listed stocks. And in many cases, you could do that in reasonable sized companies. So most small cap fund managers have gradually migrated away from small micro to small mid, in some cases solely mid, right? Yeah. And mid caps have done very well over the last 30 years, and that's fantastic. So even when you're buying a small cap fund, the chances are you're just buying a sort of £1 billion company here, or £500 million there, or even a £3 billion company or £5 billion company. So the UK small micro cap area, which we do invest in for our clients, there aren't many fund managers left in it. But the great advantage about that is even a tiny difference, because these are tiny companies, a little tiny, a hundredth of the NASDAQ market, if it tried to get into small caps, would make a transformational difference. So even just less outflows would make a difference. Clearly, no outflows inflows will make a lot of difference. So what we're expecting is what you've seen now with the mid-cap. Okay, I think it'll bounce in potentially, but what you will see is that the outperformance won't be so much mid-caps, it'll be small caps and particularly micro-caps. And most commercial fund managers in the small cap funds, if they don't want to underperform, will have to move their capital down the market cap range. One, because the transformational returns will be down there. Secondly, because the valuations are overlooked down there. Thirdly, because many of these companies are young, involved in immature sectors, and they can grow when the world's not growing. So all of these things are going to drive the capital down there. Even slight changes will make a big difference. But obviously, as we get a momentum and new capital coming into the UK, and people wanting to invest not just in the UK, but the best performing part of the UK, which would be small micro cap, then you're going to see obviously new flows coming into the UK as well. So we get into a virtuous spiral. Yeah. And yes, coming back to the answer, it's not as though we've seen a lot of clients coming in as yet. The agenda is very interesting. Our clients are gobsmacked by our confidence and the reasoning, and most particularly, we don't think it'll take much to change things. We've got a little sort of political difficulty locally, but apart from that, and which I think actually might clear within the next month or two. I don't know if it will, but I've got a view. And so it could just turn like that. I'm slightly frightened by how low valuations are and how quickly share prices could rise when we get to the other side of this.
Yeah. Mike, do you operate particularly on the sort of smaller company side and helping companies raise capital? Yeah. Are you seeing any kind of sea change or in that environment as well, or is it still quite risk off?
Certainly, it's right now it's pretty risk off. I mean, as a business, as CrowdX is forming, we're still in the plumbing phase. We're a technology company, we're a venue, we sit in the middle. We've got to wire that into the city, guys like Gervais and everybody else, so they can interact with our market. What we have seen though is, certainly anecdotally over the last 6 months, a lot of kind of very interesting regional players throughout the UK, certainly the north around Newcastle, Liverpool, these kind of areas. Yeah. That's where a large group of our clients are emerging from, because these pockets around the UK that are very vibrant and exciting. Our focus is more around, it's more about transparency in this kind of growth to pre-IPO phase. By the time they grow up and they're ready for, institutional investors like Gervais to look at them, we have that transparency, we've got that data, we've got that trade history in place, and also for the company, it makes that transition away from us onto public markets, should they choose to do so, much more seamless, and they're a known entity at that point. So it's all about raising awareness, being the champion of the business as it grows, plugging them into the right advice, the right ecosystem around it. That way they're on that journey. And look, we're not reinventing the wheel here. This is already happening. North America is a much more familiar relationship with equity within businesses. Employee shareholder schemes and whatnot are much more prevalent over there. There's companies like CrowdX and Forge and whatnot. They are driving this movement within, private equity, growing exciting companies, putting them on the map. We're not doing enough of it here in the UK. But with our technology, we can certainly bring a lot of life to that space. And furthermore, in other parts of the world, as the technology company, we're looking to look at other interesting markets. Could be India, could be, Australia, and join the dots in between. And we get much more of a broader data piece around the world with what's going on, which serves us all well at the end of the day. It's all about data at the end of the day. It's all about being able to identify, being able to pick stocks effectively, understand the teams behind them, understand their story, and also add in layers of factors like ESG data, impact reporting, all of the stuff we need to help us make our informed decisions about stock picking. My background, I spent 7 years as a market maker, and I spent 7 years avoiding phone calls from guys like Gervais. make me a price and size, oh no. And it was more about risk avoidance in that world, but it's certainly fascinating here. And as we embed ourselves within the ecosystem, understand how people interact with the market much better, I think as a technology player we sit very well in the current climate.
Yeah. And I think it's worth emphasising, the market. I'm glad you mentioned that, Mike, because actually this is a two-way price. You may not like the two-way price. Certainly current prices are very low for various reasons. But the point is it's a two-way price. What's the huge advantage of that over perhaps other pricing mechanisms, which are more reflective of past or transactions or whatever, is it's just alive, it's today, it's going right on, it reflects all the news.
Yes.
And I think that aspect of quoted markets, giving you the right price at entry, giving you access to new capital is going to be a feature which is going to become more valued by clients going forward, as opposed to some of the other structures which perhaps have done well over recent years, but perhaps may be found to be less resilient at times of uncertainty.
Yeah, correct. Yeah.
Can I bring you back to the UK market then, which is I guess the point of maximum fear right now. What else could possibly go wrong is what you think. But I think picking up on your view that actually it could change pretty quickly. So I think, like so many, financial systems are built on confidence, and there was I guess poor communication around the mini budget is what led to a draining of that confidence. If that confidence is restored, either by meaningful policy decisions, or that actually people start focusing on some of the supply side changes that the government is proposing, that hidden in that sort of mini budget was changes to IR35, which actually would allow people more flexibility in their cost base, things like that. So if you start to see that, is that the point where you think that the UK suddenly starts to attract interest again, or you'll start to see the catalyst for the change in valuations?
Yeah, I mean, I think if you look back over the last 30 years, and even in the last 10 years for the Conservative government, one of the features has been that they've been very happy to use processes to keep the world growth going, but not necessarily generating productivity improvement. When you inject QE, yes, you get share prices up and things go on, but you distort market prices, and when you distort market prices, you get poor allocated capital. And if you look not just the UK, but around the world since 2008, basically, productivity has been flatlining. It's just not working. And so you get more inequality in terms of the rich and the poor, which is obviously not necessarily a good outcome long term. But much more importantly, a lot of people where wage growth is driven by productivity improvement haven't had a decent pay rise since 2008. And then you overlay that with a whole lot of energy crisis or cost of living crisis. And I don't know if you rent a flat, but if you rent a flat, price has gone up a lot. Plus, of course, mortgage is going to go up. So going back to all of that, we're in a bit of a hole from that point of view. So we don't need to do more of the same. And one thing I can say about the new government, and I'm not overall, I'm generally not impressed by their political tenor, but I think they are moving in the right direction. They're trying to do something different. So I think that's good. I think they're trying to be business friendly. That's good too, because if businesses succeed and you get productivity improvement, you can then afford wage rises above inflation. So that's good news. But most particularly, how are they going to square the circle? They want to keep giving the teachers and the schools and all the NHS and all the rest of it the cash. They want to cut taxes over here. How are they going to make the budget balanced? Everyone's kind of confused by that. And there is one solution, and I think they're going to do it. It's controversial, but I think they're going to savage, actually, the expenditure on the civil service. So at the moment we've got nearly 500,000 civil servants. A lot of them are doing very good jobs in all sorts of agencies, but I think my view is that they're going to say, we just can't afford it. We need to give money to the frontline teachers and the frontline nurses. We can't afford all this stuff in the middle, and I think they can save 15 billion by taking that amount. That's going to completely, if I'm right, and we'll know by the end of this month, then that's going to catch most investors 100% wrong, because they just think we're kind of game over and we're so useless. Most long-term investors don't think the UK is going to do much. Most international investors have come out for us from years ago. Even most domestic investors, I'm talking about some of the wealth managers, have been gradually reducing their UK positions, and this year there's been lots of redemptions in OICs as well. So basically, this would catch everyone with a tiny weighting in the UK or no weighting in the UK at a time when suddenly we actually are probably not just becoming one of the best performing markets in the world, but actually, in political terms, actually doing some of the right things, which is reducing the size of government and letting businesses get on with it. So it could just turn, and I'm slightly fearful, as I said, of just how much the market will recover, not just equity market, bond markets. You might see the pound rising. And so, whereas the FTSE has actually held up pretty well this year to date, because international earnings, dollar earnings, FTSE's 80% international earnings, it's done really well. You'd find the FTSE wouldn't do quite so well, and a lot of the small companies, and particularly small micro-cap companies, which are on very low valuations and P's of 3 and all the other things, could just shocked people by how much those share prices move.
Yeah. Okay. Is there any concern? I mean, we've seen it that you know, particularly foreign capital coming in and just picking off UK companies. So this raft of takeovers that you've seen over the last year, particularly from the US, where you know the UK seems to be on sale. And is that something that worries you, that actually you know the best pickings will be taken out and taken private anyway?
Well, there's something really quite funny about this. The private equity and some of the takeout things have got so large that actually the unit size of most small companies is too small for them, right? So fortunately, they're not even interested in the 25 or the 250 million pound company. Yes, they're interested in Morrison's, and yes, they do, you know, massive leverage. They took 8 times leverage on that when they took Morrison's over. It's slightly disappointing. You know, I think it would have been a good quota company, but it doesn't really matter. The point is, coming back to small and micro cap companies, there might be some takeovers, but I'm not so worried about the takeovers because they're too small. Isn't that ironic? But when they've gone up over the next, say, 10 years and they're worth a lot more, perhaps we might get a lot more takeovers. But let's not worry about that. They're quoted. Often they're well capitalised.
Yeah.
There's potential for institutional interest to start rising. They might see their own valuations rise. They may be able to do deals at more and more attractive cost of capital. Cost of capital might come down as the share prices rise. I think again, this virtuous circle, when you get into it, could be so exciting. So yes, I do think there's a risk of takeovers. Clearly, when everyone comes and sees us, we say we're not interested in takeover. Nearly always, we've had quite a few in the last 3 years, where we say, would you mind not doing this? It carries on, it gets taken over. We don't always, you know, Morrison's, we had Morrison's, for example. But the point is, ultimately, I think that I don't think it's as big a risk as people think.
Okay. We've covered off the near term, which is that potential recovery in confidence leads to, you know, the near term sort of rebound. Walk us through a little bit more about the sort of medium term view in terms of the UK. Is it an innovative economy? I mean, you've talked about the cash compounding nature of the businesses that you can invest in here. But what are the other attractions of the UK for you on a long-term basis?
Well, the nature of the UK market is it's perceived as boring and stodgy and all the rest of it. But most of the quoted companies, certainly the mainstream quoted companies, are capital intensive. And the last 30 years, capital's been free. So capital intensive has been no commercial advantage at all. But when you do get capital intensive businesses, and I'm not just talking about Shell, you know, some of the mining companies, I'm talking also about quite a lot of the financials and other areas. Well, if you've got, you know, we saw plus 500 reported results a couple of days ago. They've got $960 million cash on their balance sheet. Now, last year, that may have made, you know, a million or two. This year, of course, it's going to make quite a lot of millions. So capital-intensive businesses suddenly get very well. So that's the first point. The second point is actually that actually going forward, we're going to find that actually many businesses come under margin pressure. So specifically, as I said, margins have been enhanced by the use of debt over the last 30 years, not by the companies, but by the people buying the products. As I say, I think people aren't going to be taking so much debt on. In fact, they might be repaying some debt. So I think margins are going to be under real pressure over the next 12 and 24 months, but probably over the next 5 years to talk about the medium term. And so most companies, even if they think they're okay, may find that actually they've got sort of 2 times EBITDA in debt. They suddenly find they've got 5 times EBITDA because they come under margin pressure. And their banks are saying, you know, I don't want to lend you that money. Just send us a check for half of it and we'll then roll over the rest of it or whatever. So I think there's going to be real shortage of capital. Well, if that is the case, suddenly capital-intensive models become very, 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 very strong when they start making money. But of course, companies which are agile, small quoted companies which, where the world's growth is not coming through or it's cyclical or whatever, if you've got companies which are servicing a immature sector, I'm talking about small companies here, a novel sector which isn't big enough to be part of interest to big companies but to small companies, you could see that sector continue to grow as an immature sector, a structural growth trend, irrespective of world growth. And of course these companies can invest, take market share, grow their market position. And what happened in the 80s was eventually big companies didn't grow at all, or not much more than inflation, but what they did do is they kept taking over small companies. So I think at that stage, we need a bit of growth. Let's take care of that specialist here or that specialist there. So you get not just the share prices of these small companies sort of compounding as they generate and invest capital for premium return, but you then see that you actually then, at the end of the time, if the board are happy with it, the company's taken over and it becomes part of a big company, and that's a very virtuous spiral. So valuations of small companies become a premium relative to large caps as opposed to a discount, which is where they are now.
Okay, and it's my final question, and I think we should open it up to the floor after that. you hinted on some of the attributes that you would be looking for a company, and I wonder if you could sort of provide some signposts. So you talked about sensible balance sheet, you don't want to be over leveraged, etc. The moat, so there is a barrier to entry, and capital being one of them. The ability to grow market share is a driver. What other things are you looking for when you're investing in a company?
I mean, the key issue is what is the finishing post, and the finishing post is they generate disproportionate amounts of cash. Yeah. So it doesn't happen to have this year or next year, it can take a while, but most particularly, investing now capital to get premium cash afterwards. But that's going to be pretty tough, let's be honest. World growth is going to be patchy, lots of sectors won't do well, lots of companies will be cutting prices to keep hold of their customers, margin pressure is going to be there. How do we invest in companies which are going to resist margin pressure? And one of the features, one of the good things about writing the book was I had to think about this, and one of the answers we came up to was actually, if you want to hold on to your customers at a good margin, it's not about just having a moat and a strong market position. Ultimately, you need to actually deliver not good but outstanding customer service, right? And so we ask our companies a lot, tell us about your customer service. And they say, oh, it's marvellous, you wouldn't believe it. Fine. In that case, tell us about your board papers. What proportion of your board papers is measurement of customer service? Oh, well, not many people ask that. Well, no, I'm interested, right? So you go on from that, and they usually make an answer up to me on some of them anyway. So, oh, it's 15%. Right, so tell me about last month's board papers, right? What was your customer service here? Which was your best bit? Which was your worst bit? How was it previous month? How did you do during the COVID period? How was it a year ago? Tell us about some mystery shopping. And quite quickly, you meet management teams who really care about customers. Yeah. And you meet lots of other management teams who are slightly remote from the business. They live in a little C-suite up here, and they send missives down to the front line. Would you mind doing this? It'll be marvellous for the business. And often, it's not just not marvellous for the business, it makes it harder to deliver customer service, right? And so, if you meet companies, and you will all meet companies a lot, right? How many companies go through customer service in their presentations? Like near zero. It's such a significant way. So coming back to that, it's not just about customer service. If you want to deliver customer service, you have to look after your staff really well. So, motivation, engagement with staff. So we're interested in how many staff surveys have you done? What have you done about your staff surveys? If you're in the front line of your business and you think the management team, albeit that they're very elevated, really care about what you're doing, make it easy for you, it's very motivating. People love working for those businesses, and therefore it's easier to recruit staff, retain staff, and all that kind of stuff. So we ask a lot about that. So those are the two areas which I think a lot of mainstream fund managers don't do a lot now, but I think it's going to become much more popular.
Let me take a moment to try and open it up to the floor if there's any specific questions. Anyone has a question for Gervais that they've been wanting to ask?
Yeah, I was just interested, Gervais, thanks so much for your comments, as if you think there's any, sort of, as the market structures have evolved and the participants are involved in much more retail and more technology, do you think there's any supporting actions that could be done to improve the operation of markets or the regulation of markets in some ways? Is there anything that you would advocate on that in terms of improvements there?
Yes, I mean, one of the features which has been very much out there for the last 30 years is liquidity, right? The nature of ours, we had lots of products being imported. This involved a lot of dollars. There's been, dollar being the reserve currency, there's just been wonderful liquidity for the last 30 years, as we know. So obviously, as a result of that, the cost of dealing has, the commission rates have gone down and down and down to near zero. And then we say, to Mike and his team, right, well, it's just not very liquid. It hardly ever trades, meanwhile, we're paying almost nothing for liquidity, right? That is completely backward. We value the market. We value two-way prices. We value people putting capital to work so that there's more liquidity in there, right? So one feature which I have recommended to the London Stock Exchange, I've talked to the Treasury about it, I may talk to the FCA in due course, is I think that we should have listings where you don't just have, like it is, if you're investing in Marks & Spencer's, you can deal at 1 bip or 2 bips. But actually, for some companies, if you choose to, you say all transactions go through. It can be any commission you like, but as long as it's more than 20 bips, right? Or another listing, maybe you can have any listing, you can have any commission you like, as long as it's more than 60 bips. Well, if you've got a company where you're dealing in it and you get 60 bips on both sides, that's 1.2%, right? Effectively, suddenly, as a market maker, you're making more money, right? And you might just say, well, I'm going to make a market in that stock, right? you do more volume, there's more market makers, the share price is a bit more volatile, but the point is you get liquidity in, right? Markets are about liquidity, and one of the problems with small and micro caps is people say, well, I couldn't invest and I can't get in, I can't get out. Well, let's do something about it, right? You know, it may seem that we're costing our clients more, but our clients value liquidity too, right? And it means the cost of capital will come down. So this is just a virtuous spiral again, which I think would make a massive difference. Now, obviously, it's just one idea. There may be others as well. But let's just love the market and make it more liquid.
There was a question over there.
Well, it follows on from that, really, which is the structure of the market. Again, at the moment, I mean, with the AIM market, there's more focus within the broker community on being a nomad and the returns of being a nomad than there is on being a broker. And actually, what's it? I mean, if you look at the companies you quoted, there's quite a few actual companies who have nomads who don't actually have a meaningful broker. How can those companies ever succeed on the market?
Yes, I mean, coming back to the commission level, I mean, one of the interesting things was, you know, we had lots of school ties and all the other things which were disadvantages back in the pre-87 days. But actually what was interesting about that period was you did have a break between the advisors and the market makers. I'm not saying that has to happen going forward, but it was a feature, so it has happened. But obviously the key issue, which was obviously unwelcome at the time, was you had fixed commissions. Right? And so most market makers, most advisors, were very happy to launch a new company on the market for a very low price. They often charge 3% for capital rather than 7 or 8, which you might, or maybe more you pay now, right? But what they made their money on was all the turnover afterwards, right? Yeah. Now, I'm not saying we have to do the same going forward, but that system worked really well because you had more volume. And coming back to your companies which have an advisor, then market makers can be separate. Winterfloods and Peel Hunt and some of the others are there. You know, we've got CrowdX we're talking about here. So from that point of view, I think we just need, again, it's sort of quite similar answer, which is if we really think about oiling the wheels of markets and the liquidity of markets, be their advisors separate from the advisors or part of the advisors, doesn't really matter. Then that's the way forward here. Yeah. And as it becomes a performing sector, as the UK's top performing market, one of the top performing markets, as you see small caps outperforming the best performing part of the small cap market, of the UK market, then you'll get capital coming in, you'll get more liquidity, and just as you saw sort of liquidity building up in many of the other areas, you'll see it build up in small caps, in my view.
What about free float when it comes to IPOs?
So it's interesting. I mean, what I'm interested in is liquidity. So I'm not so bothered about whether it's 20% in free float or 10% or 80%, right? The main thing is how much does it turn over, right? So from that point of view, I think some of these absolutes, I think they're rather arbitrary. You know?
Yeah. It's just when there's that lack of liquidity, spreads naturally start, going as wide as the ocean, and stocks just languish at that point and they rarely come back.
But I mean, take investment trusts, for example.
It's risk off, yeah.
Investment trusts, they don't have profit warnings, so from that point of view, the share price moves up and down. But there's 100% free float, and yet look at the spreads on them. I mean, they're just huge. Massive, right? Yeah. It's liquidity the issue, not the free float.
Yeah, okay.
Tony?
Gervais, how concerned are your clients about ESG issues, and how does that drive your agenda?
Yes, I mean, it's interesting, isn't it? There are some clients who want to invest in companies which are already well positioned for climate change, and that's fine. But obviously, the great advantage of most investors, ourselves and others, is that we're investing in companies which aren't necessarily doing a great job on climate change, but they need to do a great job in the future, right? And they need lots of capital to do that. And the one good thing about fund managers is we're able to write checks on behalf of our customers, right? And facilitate this process. So we've got companies which are probably moving ahead of others because they can invest, they've got access to capital. And if they do move ahead of others, then if they're servicing large companies or if they're servicing the government departments, they might get extra contracts because they've done better. So I think it's all a virtuous spiral again. And I think, the UK leads the world in terms of ESG. We've had the Cadbury Code back 30 years ago, whenever it was. We've been good in engaging. I think the UK fund management sector is above others in terms of engagement. I think we're moving ahead of others in terms of actually addressing ESG and climate change and reducing carbon intensity and all that kind of stuff. So I think it's important, but most particularly, what our clients aren't interested in whether we're perfect yet, but I want our companies to become more perfect. You know, we don't want to just eliminate all steel companies from our portfolios on the basis that they're wicked guys. Well, what would we do without steel, right? How would we build windmills and all the other things we need to build without steel, right? We've just got to find a way to help them to become lower carbon intensity and viable businesses on the back of it.
Can you see more legislation coming the way of companies that they have to?
I think the market will do it. I don't think you need legislation. I'm sure there may well be legislation, you know, but generally, I think that the market's, you know, and we've got companies. I mean, I've got Galliford, for example, Galliford Try. It's a construction business. It does a lot of public works, and they want to become carbon neutral by 2030. They think it's in their commercial advantage to become carbon neutral by 2030 as opposed to 2050. That's impressive stuff.
Question at the back.
Yeah, Sonny here. My question is, how optimistic are you about the developed countries' economy, given the de-dollarization of the world, which is literally ongoing at the moment as a result of global reforms of many countries, nearly 80% of the world population, countries calling for global reform at the level of World Bank, IMF, and all those things. And you have a parallel financial payment settlement system that is being produced. You also know that developed countries, they are highly dependent, their industry and economy is highly dependent on the energy, access to energy, access to natural resources, rare minerals, and all those things. And if you have the dollars, which has been very much the only currency, the major currency for international trade, losing ground, don't you think there's going to be, we are heading towards a currency, monetary crisis that will weaken the developed country's economy?
Sort of yes, I do, actually, yes. So the nightmare is that the stronger the dollar gets, the more that countries which rely on dollar or dollar lending or whatever find it's tougher. I mean, and absolutely, you know, my own view is that if you take China, big case, is that, you know, I think they have become addicted to dollars, and as a result of that, I think that you know, as the dollars got stronger and stronger, their ability to get dollars to repay the debt or to fund the interest charges is getting tough. And what we're going to see, and I think this is not just, it may happen in China, I don't know, but it's going to happen in a number of countries, is you get into a position where they just can't make the, you know, they haven't got enough foreign exchange. And so going back to 70s, right, one of the numbers, we didn't used to worry so much about, you know, how many people were employed this month, or indeed inflation, although that was, the number one figure watched in the UK was the trade balance, right? And so I think coming back to developing countries, I think it's going to be tough. And I think some developing countries like Argentina and Turkey probably have already got currency controls, and it's difficult to get dollars out of those currencies. You know, you can only do it with permission at the right level or the rest of it. I think that pattern will become more wide-ranging. I think there will be opportunities for developing countries which are well-balanced and do invest for productivity improvement to actually generate surplus cash and then find that actually they can get access to the dollars and their currency doesn't go down. The problem with, obviously, with some other developing countries is, unfortunately, for whatever reason, they don't invest very well, or if they do invest, the leadership take too much of it and run off or whatever, and that is still going to be a risk, to be honest, going forward. But I think there will be real opportunities, actually, for the dollar to peak out eventually and all the other things to worry about. But most particularly, I think the developing countries, many cases, you know, particularly Asian markets have done very well over recent years. Eastern Europe's done pretty well. A lot of African countries, though, there's so much opportunity for them to do stuff. Yeah.
Yeah. One little comment and then
yeah.
For example, in the past 20 years, what we've observed, especially in developing countries, is that they have natural resources and all this energy, and then they sell this to developed countries, and then they have to get the dollars or even have access to like the euro, all these major currencies. So, and then the developed countries give them the euros or the dollars. So they have a lot of dollars, and now they take the same dollars and then reinvest it into the bond market of the developed countries. So literally, so the developed countries, what they just needed to do is QE. If they want to buy oil and gas, they just do quantitative easing. They print, central bank, they print the money, send it to the bank, and then they take that money they buy. And then these guys from developing countries, they still take the same money, they invest, they buy the bonds of
Absolutely,
those
yeah.
countries. So literally, they end up with nothing.
No, that's right. It's called the,
See what I mean?
it's called the Lucas paradox, actually. So it's you can make very good returns by investing in less developed economies. The premium returns, massive returns actually, but people don't leave it there because they're unsure as to whether it's safe. The rule of law, ownership, property ownership, and all that kind of stuff. So we need to help developing countries to develop those layers, those institutions, which then allow, obviously, the capital to remain, and then you get that virtuous spiral. But the danger is that some capital goes, and as I say, it's been a problem for many years, as you know.
We're about to come up to time. Is there any other questions, Rob?
Yeah, just a quick one. What do you think, Gervais, about all of the share buybacks that have been going on during the course of this year? If there's such good opportunities for companies to invest in improving productivity, why are they buying back shares?
I'm not at all happy with it. You'd be surprised to hear. So coming back to it, I mean, I'm not going to take a FTSE company just because I just happen to know the data, right? So you've got a company called Direct Line, which is a car insurance company. Had quite a strong balance sheet. Coming up to pandemic, they were going to pay a decent yield, and they were going to start a big buyback at the time. Obviously, the pandemic arrived, and they felt so panicky, they cancelled the buyback. Quite understand that. But they actually didn't pay an ordinary dividend either. They cancelled the ordinary dividend. And you've got to say, well, just remind me, what is it about car insurance which was not going to happen beyond the pandemic, right? Anyway, they kind of worked it out, you know, so they repaid their dividend and stuff. More recently, right, they've also done a buyback. And the share price is high, and they've got out some marginal people. What's happened subsequently, and you'll know this as well, is that used car prices have gone like this, right? And you can't always get windscreens of Teslas or something, and so insurance claims have gone through the roof. And so they've just said, well, I'm terribly sorry, we're not making so much profit. We've stopped our buyback, having bought the share price, the share price collapse. And by the way, our earnings are going to be disappointing, and we might not even maintain our dividend, right? You think, you've been buying loads of shares up here, now they're down here. You're not even having a buyback, but you're not even paying a dividend or reducing your dividend. Ludicrous, right? They do it because they thought their P ratio was, 8 or something when it was up here, but they had no concept. Generally, don't buy back shares, right? Because nearly always you get it wrong, and even if you get it right, you just get out some marginal shareholders at a slightly better price than they would get otherwise, right? We're not interested in that. Cash becomes important. When capital is constrained, cash becomes even more important. I think the opportunity now is for capital to be put to work. Every company which comes to me with a buyback, I say, I'd rather you didn't, please. Better dividend growth. Invest it for more cash paybacks in the future.
Thanks, Rob. And I guess that we'll draw it to a close there. There are some papers for you to take away, which goes into a little bit more detail. So please do help yourself. Can I just take a moment to firstly thank all of you for coming. Thank Mike for working with us to put this together. And of course, thank you, Gervais, for providing the insight.
Thank you.
And just a final thanks to Lucy and the team for putting everything together today and hosting us so well. There is some lunch afterwards, so please do hang around and enjoy the conversation. Hopefully they will put it out once we wrap up. Gervais, it was always a pleasure to see you. Thank you very much for doing it.
Well, again, thank you very much, Mike, Neil, the whole team here, Lucy, etc. It's been a pleasure, to be honest. I mean, it's so exciting to be talking now. As I said, I've been waiting 30 years for this moment, right? So I've got some economic stuff which you might find of interest. Yes, I'll be around with the others and we can have some good conversations.
Excellent.
Thank you very much.
Thank you.
Thanks, guys.